Lou John Quinto, President and General Manager of Blue Cross Blue Shield here in Connecticut.
Good morning, Susan Halpin, and I'm here on behalf of as the Executive Director for the Connecticut Association of Health Plans, which is Aetna, Anthem, Cigna, Connecticut, and United. Thank you.
Good morning, Paul Brandt from United Healthcare. I'm Vice President of Sales and Account Management for our Connecticut team.
Good morning, Zach Moon from Cigna Healthcare. I'm the finance lead for our small group health line of business.
Good morning, Maggie Morey with State Government Affairs for Aetna.
Good morning, Jeff Hogan. I'm the president of Upside Health Advisors, a national healthcare advisory based here in Connecticut.
Morning, Wyatt Bosworth, Connecticut Business and Industry Association Associate Counsel.
Julie Schubert, I am representing the benefit brokers in Connecticut. We're National Association of Benefit and Insurance Professionals.
Representative Meskers from the 150th District, Chair of Commerce and on the Insurance Committee and anxious to learn.
Let's turn it over to JP Weisky from Health Benefit Institute.
Hi, JP Weisky, obviously. You want me to go ahead and get started? Or just intro? Sorry.
Please go forward, JP.
All right. I wanted to touch base today a little bit on I was asked to touch base on the national perspective on the small group market. First, I think it's important to understand by way of background what we're talking about. These are small group is generally defined as 2 to 50. It can vary a little bit state to state, but for the most part, it's 2 to 50. For the most part, with some exceptions in the shop exchange for a limited group of folks, and Maine and New Mexico, it is largely an unsubsidized market and generally has to meet the same sort of requirements that the individual market has to meet in the ACA. It's important to note that small employers, unlike large employers, are not mandated to provide coverage. From a national perspective, if we start looking back, and again, we can talk about what this means, but you have seen an erosion of the small group market at least since the 1990s. Part of this is due to increasing costs. Certainly, a number of the reforms that improved access to consumers, that improved the underlying medical plan, but also as a result of that, resulted in increased cost. And I would note from a national perspective, most of this work was actually done in the states pre-HIPAA. HIPAA merely codified what most states had in place. And so, a lot of states had what were called small group market reforms beginning in the early 1990s. Now, when we move into the ACA, again, we talked a little bit about the fact that the individual market looks very much like the small group market. Again, there are bronze, silver, and gold plans. I would note when the ACA first started, depending on the state, a number of states, including, I believe, Connecticut, allowed were so-called grandmother plans. This reflected President Obama's promise that if you liked your plan, you could keep it. When I left Wisconsin, in the Wisconsin department in 2019, over half the small group market was still in those grandmother plans. Now, by now, another 5 years later, I expect that if we pulled those numbers, you'd see a very small percentage, but that reflects in part this movement from a cost perspective, from the old pre-ACA plans into ACA plans, which included new mandates, new requirements, and a number of new rating factors that we talk about below, including the end of gender as a rating, which has an effect on certain age populations, both male and female. Those prices were different. The age band, there was a wider age band typically in that market. What I mean by that is that younger people tend to pay less and older people tended to pay more. Again, we can talk about whether or not there are fairness issues there, but that did have an impact on the employer market. Composite rating also had an impact. What composite rating is, it's a requirement that you come up with a sort of average across the group for a from a premium standpoint, and that the premium reflects that. Pre-ACA, typically in the smaller size market, rates were based on the individual's age and were charged to the employer based on the individual's age. And the reason that's important is that does create some potential variability. If you replace a 22-year-old kid with a much older individual, we result in on a small group under 10 lives. In a lot of cases, you will see a significant change in the average age, and as a result, the rates will change. That creates an issue. Also, the ACA included requirements of a larger rating area. So if you were located in certain areas by zip code, your rates were based on that. Now it's a larger rating area. It's limited to metropolitan statistical areas as a matter of course. And so those wider areas mean that the coverage can vary, and it's a little bit more difficult to sort of go through that process. Last, modified community rating, which was already largely in place in Connecticut, but it requires that rates from a group-to-group basis are merely based on the allowed demographic factors, no variation based on health status or anything along those lines. Again, we can talk about whether or not those were from a public policy standpoint. It is what it is. That did mean that there was a little bit more fairness, but it does mean that folks that are healthy are sort of disincentivized into the market and look at the market differently. And so those are just important factors to note as we're looking at what's going on. This is the main slide from my perspective that I want you to understand. This is largely dropped off post ACA from a discussion standpoint, largely because legislation both nationally and locally have had an impact on what you can do here. But the point when you look at this slide is anything you do with access, availability, or affordability affects all the other tiers. So if you want to make something more affordable in general from an insurance perspective, so if we're stepping outside, maybe we're looking at the large group market, maybe we're looking at something else where you're allowed some additional flexibility. If you do want to make it affordable, you have a couple of options. You can certainly use underwriting to limit the folks who have access to that, either charge them higher rates or you can decline coverage. Similarly with medical, if you want to have a more affordable rate, you can sort of restrict coverage. You can use tighter managed care aspects. You can certainly use some other pieces from a network standpoint, have narrower networks. That's certainly what we've seen in the ACA, is that the ACA networks are significantly narrower across the country than they were pre-ACA. Similarly with some of the looks at the availability of medical care, sort of restrictions from a managed care standpoint, despite some of the rules, there's certainly some efforts to take a look at that. The point here isn't to say that you shouldn't do these things, that there aren't sort of universal goods that may come from them, but the point is to say that there are significant costs that attach to them, that every time you make any sort of impact on any of these, you impact the market as a piece of it. So everything should be seen within that lens. What does it do to access, availability, and affordability? And when we look at it, ultimately, we'll get to this a little bit more in a second. It also, when we talk about the access to insurance, we're also talking about the number of insurers that are willing to participate in a market. And so that is the sort of ultimate, is the folks start looking at withdrawing from the market. Again, when we talk about this, when we're talking about access, we're talking about guaranteed issue, modified community rating, the narrowing of the rate bands. These things do certainly make them more fair, but it also creates adverse selection issues, right? So it can create an issue that you are now subsidizing folks who use medical care more. And so therefore, it becomes less insurance-like and more social good-like. And that's, again, there are trade-offs that we just need to be aware of from a policy perspective. I'm not arguing that we should move back away from guarantee issue. I'm not arguing that we should, and even though we can't, or that necessarily that modified community rating is there, but I am saying that they do have an impact. Similarly, with rules surrounding the availability of medical care, again, these things, the mandated benefits, there are certain pieces that are mandated that will have a cost, will have an impact. You have to take a look. These things are not free as a matter of course. Similarly, with limits on utilization review, there are a certain number of dollars that are available. And, insurers have an interest in ensuring that the medical care they're providing is effective and cost effective to the consumer. The more and more we mandate and require coverage, the less and less ability they have to sort of take a look and get the coverage right and ensure that consumers are receiving value for their dollar as it goes in. And again, affordability, certainly, a couple of these things that we've talked about sort of artificially create some value. Medical loss ratio creates some value from the standpoint of looking at a standard across the board as to the percentage that is spent on medical care. Rate review can do that as well, in ensuring that companies are looking at their rates in a consistent manner. However, when we look at rate review, there's also two sort of pieces that go along with that. There are two responsibilities. One is related to ensuring the rates that are fair to consumers, that you're looking at and making sure that there's not undue issues that are attaching. But equally important from a rate review standpoint is making sure the rates are adequate for the insurer. If we look at the crisis in the property insurance market across the country, especially in certain states, you can see that their ability to be able to get adequate rates or not being able to get adequate rates means that they withdraw from the market, that they move away from a coverage standpoint, that in some cases that they exit the market, pieces of that market altogether, either counties, states, or entire states, or even exiting the market in its entirety. In the long term, the problem becomes when these things are looked at from an artificial standpoint, meaning that you're looking at a medical loss ratio that's too high, or you're looking at a rate review that is particularly aggressive and creates a number of issues. I would note in the state of Wisconsin, we had a competitive rate standard in the individual market early in the ACA, partly because the ACA rules and the adjustments. We saw well over $200 million in loss reserves in the individual market, which meant we had a significant number of folks that exited that market. While we still had like 13 carriers, in fact, in most counties, we only had 1 or 2 carriers competing for business. Ultimately, we had to pass a state subsidy in the individual market, similar to what other states have done, and that brought folks back into the market. We did that subsidy, in fact, through a reinsurance program, which lowered rates for consumers and brought new insurers back into the market. Do want to note here that we have a giant wave coming. In addition to working for the Health Benefit Institute, I do some work with some other companies as well, and one of them is dealing with gene therapies. You see we mentioned the gene therapy here, the hemophilia gene therapy. This is a horrific disease that creates horrific issues and is insanely expensive, runs $600,000 to $800,000 a year. In some cases more, in some cases a little bit less. But on the horizon, we have these gene therapies coming. And in fact, you see there a number of gene therapies that, in fact, for both sickle cell, hemophilia, and spinal muscular atrophy that have been approved. These are all in excess of $2 million for their treatment. Typically, it's a one-time treatment. A number of them are offering warranties to ensure that it works, and will offer significant refunds back if it does not work. But we're looking at a wave of new gene therapies as these develop, which is going to significantly impact the costs in the medical market, and it's something that states are going to have to start looking at coming forward. So again, we expect up to 30 gene therapies will be approved in rather short order. And again, if you're looking at these costs, these individual medical conditions, the treatment is significantly expensive. There may be a long-term ROI that attaches, but unfortunately, there are going to be significant cost issues that move through these markets. It's not all bad news. I tend to, in some of these presentations, come across as a negative Nelly. I do want to note a couple things. So first, we had done a study a number of years ago with North Dakota, looked at some national data. What I found was interesting related to Connecticut from that study is, in fact, despite the fact that Connecticut had the second highest medical costs in the country on a per member per month basis. In fact, premiums were lower than that, which is a little bit of a surprising result. That indicates some good care management by the insurers in the market. Also note that insurers are largely, funding this market and, with significant medical expenses. Also, from a performance standpoint, the state is starting to measure a number of these, the benchmarks as we go through, and the state's done a lot of good work on this front. And it looks like insurers are largely getting better at meeting the sort of nationalized population health targets that they're looking at. So there's good news there as well. And last, want to note that the state in a recent look at markets has a very good health status. They're a fourth overall health market across the country, as looked at by America's Health rankings. We've got a link to that in the end if you guys want to take a look at it. But there are good news. Lastly, what I want to leave you with is a couple of broad points. One, the small group market is a unique set of problems. All the rules of the individual with no subsidies apply, and this creates significant issues in this market. From a standpoint of Connecticut insurers, they face high medical costs. As you know, there are fewer and fewer insurers in this market, which indicates some concern about the risk in that market. And so there is some concerns there as to how you sort of make that work. And from a health reform standpoint, there has been significant expansions of cost. There's been and access here. That comes at a cost. And that's part of what we're talking about here. I think most importantly, both nationally and largely locally, I know there's been a lot of talk over the last bunch of years in Connecticut about what to do with the small group market. But nationally, there's been very little effort to work with the small group market. We've talked a little bit about New Mexico and Maine putting together some subsidy programs that help with affordability pieces. We've certainly worked as a group to try to find some solutions nationally through Congress, through our Council for Affordable Health Coverage, a sister coalition to HBI. We've pushed for some reinsurance. We've pushed for other sort of reforms that attach that we're looking at. But this market has largely been ignored, and that creates where some of the problems are. Last, there are a number of solutions that we will likely talk about later that can both expand coverage in the small group market and make it more affordable, and expand access to insurance for small employers. We're looking at that. I think all solution options is sort of the way to go. So I'll stop there, and it sounds like we'll answer questions later. Thank you very much.
Thank you, JP. Next, we have the history of the small group market from a regulator's perspective. Welcome, Paul Lombardo and Jim Carson from the Connecticut Insurance Department.
Thanks, Rep. Wood. Good morning, everyone. I guess doing a history lesson means you've been around for way too long, and to be perfectly honest, I have been. Next slide, Jim. I want to make sure everyone understands this is the history of the small group fully insured market. That's what the insurance department in Connecticut has regulatory authority and statutory authority over. First slide is an enrollment history. You can see the numbers up there. There was a little blip that is not explainable. I don't have an explanation in 2019. But obviously from 2015, over 200,000 covered members in the small group fully insured market to today of a little less than 76,000. Now that obviously changes. Small group themselves, numbers change over a period of time. Some of them become large groups. In Connecticut, our market is defined as 2 to 50. So as small groups grow, they become large group for insurance purposes. Some of them go out of business. Some of them move out of state. But some of them choose alternatives to fully insured. And I'm sure we'll get into that conversation a little bit later. Jim, the next slide, please. What you see in front of you are the weighted average requested, which is, for example, in 2015. The request in the small group market was 6.1% increase, and the department approved a weighted average of 5.4. And again, you can follow that from year to year. Through 2024 represents the decisions that were made last year for the 2024 benefit year. We had 1 year where the actual request was negative, so there was a reduction. That's obviously not something that happens very often, and we approved slightly more of a decrease than what was requested. Okay. Market exits. We've had a significant number of them for different reasons. The first one was Healthy CT, Inc., which was the carrier that was developed and created by the ACA in a number of states. Healthy CT was our ACA created insurer that began in the individual, small group, and large group markets. They actually went into receivership in Connecticut. We took them over at the insurance department, put them into receivership. The good story is that all the claims and the liabilities were paid for Healthy CT. The reason why Healthy CT struggled twofold. One is, if you recall, there were 3 mechanisms to start with the ACA. There was reinsurance, there was risk adjustment, and the third was arguably the biggest issue, where there was a situation where the carriers expected to receive a significant amount of money, and the money wasn't there. And in fact, what ended up happening was the insurance department actually sold that amount that Healthy CT was due, and it was approximately $30 million. The department sold it for about $7 million, and that helped to pay for the existing claims and all the liabilities for Healthy CT. Now, there was companies buying up these liabilities, and it took a significant amount of time, and I don't know exactly when, but it may have been maybe 3 or 4 years ago, where it was finally settled, and it was settled in favor of the carriers. Well, that was too late, okay? For a number of these ACA developed health plans. And these health plans primarily were owned by providers. Okay, that was the concept here. The amount of money that the feds gave each of these companies was not meant to be a repayable loan. Well, they converted it into a repayable loan. That was another issue. So everything that transpired for those types, there may be 1 or 2 out of 40 or 45 of these types of ACA developed health plans that exist today. I don't even know if any of them exist, but most of them went down the path of receivership. So that was Healthy CT. Harvard Pilgrim Healthcare of Connecticut and Harvard Pilgrim Healthcare Insurance Company left the market effective 2021. They were a carrier that was regional in the Northeast, based out of Massachusetts. They decided to enter the Connecticut market. Frankly, it's very difficult for any carrier coming out of state that does not have a developed network to develop their network at a price point that is necessary for them to compete in Connecticut. So Harvard Pilgrim came in. The first year, they maybe had 1,500 members. They needed to adjust their pricing, and that was our role to say, hey, wait a second, you can't lower your rates by that much. But and this was Healthy CT as well. Both of them had this issue. The risk adjustment is a significant impact in our marketplace to new entrants in a marketplace, because you don't know the risk that you're going to attract in the marketplace. So you don't know if there's going to be a amount of money that you're going to receive or that you actually have to pay out. In Harvard Pilgrim's first year, after their first year, they had to pay per member per month, because it was such a small amount of members. They had to pay approximately $200 per member per month into the risk adjustment mechanism. So what that means is that you're supposed to increase your rates by $200 per member per month. You can't grow your business if you're at 1,500 members and add $220 per member per month to your premium. You're already high. You already can't get the contracts that you need because you don't have the volume in the marketplace. And frankly, you're competing against carriers that have been in the marketplace or are national carriers that have more resources that you're competing with. So they lasted maybe, I want to say 3 or 4 years, and they left the market. They exited, and they were in the small group market. They never entered into the individual market in Connecticut. So those were the Harvard companies. Connecticut, all 3 companies, obviously, that was effective for this plan year. Cigna Health and Life Company is effective next year, as well as Aetna Life Insurance Company. Fortunately, you have representatives here from those 3 companies, so you can certainly ask them some of the reasons why they made that decision to leave the market. So what that does is, right now, that leaves United Healthcare with their Oxford companies and Anthem participating for the 2025 plan year in Connecticut in the small group market. Go ahead, Jim. There's a significant number of items that contribute to small group rate increases. These are the ones you see every single year: annual trend, medical inflation. That accounts for rising healthcare costs, including the cost of prescription drugs, which are growing at a double-digit level consistently over the years, and therefore are becoming a much larger percentage of the premium that small employers are paying for their health insurance. And that goes along for individual and large group as well. Also, the increased use of medical service and the severity of future claims. Experience adjustments. If a carrier has a bad experience year, their claim point that they start their pricing from is much higher than it was prior to. So there has to be an allowance for an experience adjustment. That has the ability to go the other way. And we obviously saw that for the COVID years. The initial COVID experience, we saw decreases in your claim levels. Deteriorating morbidity in the small group market. You want to see the law of large numbers. The more people, the more membership in a cohort, the ability for you to spread the risk over a larger population. The first slide indicated we went from 200,000 to just under 76,000, which means that the carriers who are participating have much smaller, fully insured blocks of business. And when that happens, there's a potential for the deterioration in what we call a morbidity spiral, where the morbidity continues to get worse, especially in a situation where there's alternatives that are not guarantee issue, where the alternatives have the ability to underwrite. And you also have the ability of the small employer to move amongst these products that are available to them. And they're obviously going to want to move to the one where they feel like they can get the best bang for their buck. And frankly, if they're in an alternative product and they have bad experience, they'll get a significant increase. And the potential is they can go back into the fully insured market where, again, the risk is spread to a certain degree over a smaller amount, but the rates actually may be better than what they were getting in the alternative products. So there's a lot of movement in and out potential for small employers that impact the risk in the fully insured market. Next. I can go over, and JP did a really good job of the rating factors that were available prior to the ACA. I'll go really quickly. He mentioned the age. The feds have an age 3-to-1 ratio, and the state of Connecticut, like most other states, have adopted the federal age factor schedule. I can tell you because I was the actuary working on this as we converted, and I wanted to make sure I knew this answer. It was 6-to-1 in Connecticut prior to the ACA being implemented. So the highest rate at the most severe age was 6 times higher than the lowest rate at the lowest age. Now that's compressed. The older people are paying less, the younger people are paying more. So that was a pretty significant impact on Connecticut rates, was going from around 6-to-1 to 3-to-1 in the age area. Area factors, very, very similar to what we had before. We have 8 counties in our state. Our state law originally said, small group law said that you could not have a rating area factor or area less than a county in Connecticut. What was common back then, before the ACA, was to take the actual piece of New Haven County out of New Haven and put it with Hartford County, and then take the rest of New Haven County and put it with Fairfield, and then all the other counties were whole counties. So you didn't have an area that was less than a full county. Fast forward to ACA, they actually allow no more than 7 area factors for a state. And JP mentioned it's done on a different, it's not done on a county basis. Connecticut petitioned the feds to use our 8 counties, and they granted that. That's a one-time decision. We, at some point, could go back to them, but I think that kept the pricing by area very consistent from what we had before to what we have today. Benefit factors have always been allowed to be used in pricing. That's, you have different cost sharing, you have different out of pockets, you have different cost sharing benefits, deductibles. You have to be able to price for that. So the lower the cost sharing, the higher the benefit relativity, the lower the cost sharing, the lower the premium is, or the higher the cost sharing, the lower the premium is. Network factors, that has been allowed prior to the ACA, that's allowed today. If a carrier decides to offer a similar product with a different network, they have the ability to do that, and they have the ability to rate for that within the ACA, and they had the ability to do that prior to. And essentially the way small group carriers price it now within the ACA is they take their block of business, they develop a base rate. And so that's where the spreading of risk is. Then they take the allowable rating factors and apply them to the specific characteristics of the small group. And then they make adjustments to that base rate. So every Anthem has small group, fully insured business. Let's say they have 40,000 members. They're going to develop a base rate for every single small employer, and it's the same base rate. Then they're going to apply benefit relativities for the specific benefits that are available. If an employer chooses a network 2 versus network 1, then they'll adjust that. Then they take the actual demographics of the small employer and apply the age rating to it. where the area where that small employer is will be applied. So everybody starts with the same rate, and then that rate gets adjusted for the specifics of the small employer. But nowhere in there is it the health of the employees of the small employer. They don't get to use the health of the small employer itself or the members to specifically adjust the base rate. So these are all factors that are filed with the department. Okay, small group rate review and approval. We have a specific timeline that we develop, that we need to develop for small groups in the ACA. CMS does a timeline. We require small employers in the carriers in the small employer market to submit their filings. The last 2 years, it's been June 1st. They file it. We post them within a week. It's all public information available on our website. And then we begin our analysis. We communicate back and forth with the carriers. That communication is made public. We go through, and the Commissioner May, since he has been the commissioner, and it started even prior to that with Commissioner Wade, we have an annual informational session actually that's held here at the LOB sometime towards the end of August. We'll have the carriers there this year again. We don't have a definitive date yet, but once we do, Jim will, well, the 20th. Okay, August 20th. It'll be an informational session here that Commissioner Mays will run. And we will have all the carriers. We will have the Attorney General's office here. If they so choose, we'll have the Office of Healthcare Advocate here if they so choose to have the ability to ask questions. We will have the Office of Health Strategy. They will also have the ability to ask the carriers questions. The carriers will present. We will give an opportunity for the chairs and members of insurance and real estate to participate in that as well, in an open forum. And obviously, the most important people engaged in all of this, the consumers, have the ability to come and engage and make comments and ask questions of the carriers. So that goes through that process. We then make our recommendations to Commissioner Mays. After that informational session, we communicate with the carriers, requesting changes, if any, to be made. And then sometime in September, usually the first or second week in September, we will publish our findings and our results and make them public. And the decisions that the actuaries and the commissioner have made. We have bulletins that identify all this to the carriers. Our bulletins are on our website, that identify the timelines, that identify when everything is due for the review process. It is an actuarial review. We are guided by the rates need to be not to be excessive, not to be inadequate, and not to be unfairly discriminatory. And there needs to be actuarial support for all of the adjustments that the carriers file with the department. That's a given. That's what we were doing before, but that's a direct result as well in most states of the ACA. Anytime a carrier wants to make an adjustment, there needs to be actuarial support for that adjustment. We have guidelines that identify the minimum required of each filing and the content of the filings, and that is also in our bulletins that we issue annually in the small group and the individual market. So it's pretty laid out, and it's very, very, very public from our perspective anyways, and I hope everyone else sees that. And if you go to the next slide, there's links in here that identify how to get access to the public filings. It's what I've already mentioned about the decision process. And so that the carriers have the ability to have their rates finalized. That's another issue. And especially in the individual market, the exchange needs to have those rates finalized by early September, both for the shop as well as the individual exchange, so that the individuals and small employer carriers can start shopping towards the end of October. Individual market open enrollment begins November 1st, and the carriers obviously have renewals that are coming up as they go through, and they need these rates finalized in an appropriate time frame in order for them to start notifying their customers of what their renewal packages will look like.
Paul?
Yeah.
We have a few minutes for you to wrap up.
Okay.
Thank you.
Yeah, it is. I'm all done. Yep. Perfect.
Thank you. I'm just being cognizant of time here. Great. Thank you, Paul Lombardo. Next, we have the challenges from the carrier's perspective. And as a reminder, at the end, we have Maggie Maury from Aetna. We also have Zach Moon from Cigna. We have Paul Brandt from United. We have Sue Halpin from representing the carriers, and we have Lou Gianquinto from Anthem. I will pass it over to you, and please feel free to, whoever would like to go first, please feel free to go. Lou, would you like to go first?
Sure.
Thank you.
First, let me just state that, Anthem has been committed to the small group space for a very, very long time. And we certainly do intend to stay committed to the small group space. It's an important part of our local commitment here. We have a large size and scale in the state. I think that helps us in what can be a volatile market when it comes to, varying trends and things we see happen, as JP mentioned. A couple of the problems that we continue to face and we'll have to navigate and be part of the solution at a more global scale with the state. One is it is a shrinking market, as we talked about, and that creates a few problems just from the aspect of continuing to try and reestablish the needs of our clients in the small group space, as well as, how we reassess our P&L and risk on a year-over-year basis when we have a shrinking number of potential small group members. That's kind of internal in Anthem, trying to figure out, okay, what are our needs? What does the P&L look like? How do we reassess risk in a shrinking marketplace? And lastly, and a lot of this was talked about in JP's presentation, affordability is a problem. How can we bring an affordable product to our clients in the small group space? Certainly the trends, especially post-COVID, we've seen a tremendous number of high dollar cases. That's increased tremendously since the pandemic. That's something on the medical side. JP mentioned the gene therapies and pharmaceutical costs are constantly pushing those trends up. And JP also mentioned mandates, right? We have a lot of mandates in the state, 64 mandates. That does impact the financials. And again, not here to argue the viability or the virtue of those mandates, but it's a reality. And I would also say we have to continue to look at those mandates as far as what the impact is. We've actually seen mandates that, when passed, had a certain kind of score of a financial impact that have increased over time. So I think it's important to understand the financial impact of those mandates continuously, as well as the taxes and assessments that we get levied, which all have an impact. And if you add that all up, it's a very sizable impact to the cost of premiums. So from a macro level, those are our biggest concerns. We're going to continue in the marketplace, so we need to be part of those solutions. I know we're not solutioning here, but I think when it comes to that, there is going to be an increased need for flexibility in models, in products, in funding. of some of the mandates. Those types of things have to be on the table for this to continue to be a sustainable market. And if we can attack the affordability problem, hopefully that will bring more small businesses into the realm of the insured marketplace here. So, that's what we aim for, is to try and how do we lessen that trend of reducing members in the small group space? I'll stop there.
I think great points. United Healthcare is also dedicated to this space. Like Anthem, we do have a large footprint in the state. The intent is really to be able to provide coverage for employers, but also to members in both the small and large group space. It's important, or I should say educational, just to have an awareness that when we work with providers, they don't often know if you have a small or a large group. They're just there to treat the membership, and they get an ID card and they go from there. So, that's part of the puzzle. It's a very important one. What I want to speak to a little bit today is about the consumer. So we talk a lot about cost and benefits. We talk about viability, but we often don't talk about the member, the person that actually uses health insurance. So, maybe these are all things everybody knows, but I think it's worth referencing. Employers, we have Julie and Jeff here, they work in that space, and I'm by no means an expert as to what an employer's desires or needs are all the time, but employers are often competing for human capital. So they need to have a viable benefit. So they're going to offer benefits that are going to be able to either retain, keep, or perhaps draw in new employees or members into their organization. So health insurance is a large part of that benefit. So it's important to them. They look at the costs, they look at the affordability, look at the access to care, and they look at the benefit itself. In small group, because of the metallic levels, we really are boxed into these four categories. And I think Lou makes a really good point. Flexibility and allowing creativity to still stay in those metallic levels is really important. But we may be able to do things in large group that we cannot do in small group. So we would love to be able to bend more if we're able to. The member themselves, though, they engaging with that member is really tricky. If you think about it, traditionally, we all have, most of the folks here probably have health insurance. It's not like you really want to talk about it all the time. You really don't want to use it all the time. But what I've found is that we are evolving in the environment of how to meet a member where they're going to use their health insurance. So it's not uncommon for people to say, you've got a smartphone, use it. Let's make it easier to access healthcare through that smartphone. Another area might be when a member calls in, how do we engage with that member? Sometimes they'll call about a claim question, and we'll ask them about their health. And I'm sure what we're doing is not unique, to just ourselves. But the idea is to be able to engage and use data and technology to the extent that we can in a proper way to say, hey, we know you're taking insulin and you haven't renewed your prescription for the last couple of months. Have you seen your doctor? Things like that. So there are opportunities to engage with a member. Another area is also is to reach out to members. We've found specialty needs, things like that. If somebody is on one of these major specialty drugs that JP was talking about earlier, you're probably going to have a lot of folks helping that person manage through that course of care. And that can happen at many different levels for a member too. You might hear about disease management, there's evolutions of care management, but those are all progressing behind the scenes. So you want to make this connectivity, but you also want to make sure that members have access. We know a lot about social determinants of health. As a carrier, we have reduced copays to zero for insulin on a fully insured basis. We've also looked at asthma treatment and put a $0 copay there. So the idea is to try to open up the system and have access, and then make sure that people are using it. But I will say that the members, they're not easy, to manage. So I say that in the sense that they don't really take everything that's on the table and uses it. We have programs that incent people to be more active. That's pretty common in our environment. We have members have access to very subsidized gym memberships. And we find that honestly, a lot of the membership doesn't take advantage of it. So the member's not necessarily engaging in their own health all the time. I looked at some anecdotal numbers. These aren't, blessed by United Healthcare, but I did go online and I checked, how many people are properly getting their annual physical. And it's about 62% of the time. So 38% are not. And that's a benefit that's free. With those that have dental coverage, it's about 58% of the time. And when people have vision coverage, it's less than half the time. So we have a challenge. We need to help people engage in their own healthcare. And I mentioned, things like smartphones and devices and outreach and things like that, and they all help. But I think members often, they just, it's, use your smartphone to buy things, on Amazon, but you don't really want to, and it's not like they're buying, healthcare is not like buying a toaster or anything like that, but how can we make it more interesting for them? So that's a challenge we have. How do you access the member and how do you get them more intrigued into their own healthcare? So when common solutions that we've had, that opportunities that we've had over the years are alternative networks, which is referenced earlier. It could be tiered networks or tiered benefits themselves. So rewarding people for utilizing a benefit in a certain service or a certain setting. So that's really important as well. And then, we heard about these referral programs, we call them gatekeeper programs in the old parlance. Well, if you hear gatekeeper, it's probably not something you really want to use. And a lot of these types of programs, and they're all well-intended, and I think employers often are offered these programs. The membership, the people that actually, the subscribers and the members that actually use the health insurance are not as attracted to these benefits because they may not understand them. They're not educated. They feel like there are things being taken away as a result. And the intent of the structure isn't to take anything away. It's to try to deliver healthcare in the proper setting. So make it more efficient, meaning less costly, maybe an ambulatory setting versus an inpatient setting when it's safe to do so and the clinicians are doing so. But it could also focus on quality. So, some doctors and providers and health systems do a better job at healthcare outcomes. They have fewer redos, they have fewer readmissions, they have lower infection rates. These are things that we're able to track. So why shouldn't we be drawing membership to those types of providers and doing it over and over and over again? But despite all of this, the membership, our members don't necessarily like to pursue, those options. So, so I think there are two things, engaging with the member, making them smarter than they are now. I'm sure they're very smart, but making the healthcare experience something that's plausible and useful for them. This is not just in small group, but this is also in large group. This is, the North Star, I think, that we're really trying to achieve. We thank, Representative Woods for helping us get into the more of the copay space and offering copays for actually a full episode of treatment rather than just, a deductible or a co-insurance or a copay for one thing, but making it more of a holistic environment. And when we're able to do that, we think that it makes the healthcare system not look as challenging to a member as it otherwise might be. And as a result of that, we think that members will like that type of product. And that's something we hope to be able to deliver in the small group space as well. But I'll hold off on the solutioning as well until after all the comments. Thank you.
I'd like to start, just thank you, Chairwoman Wood, for having us here today for the informational hearing. I'll start by just kind of addressing the elephant in the room that Paul had raised earlier. So as most folks know, Cigna has offered small group fully insured coverage since 2021 in Connecticut. Over the early part of this year, we have made the decision to wind down our participation in the Connecticut state market alongside our partner, Oscar Health. We've been proud to serve Connecticut small businesses, their employees and their families over those 3 years. But during the course of that time, we have consistently seen losses in that space, and do not see a consistent future to eventually break even, and thus have made the decision alongside Oscar Health to exit going forward. We still cover level funded plans, and so small employers within the state still have access to Cigna's plans. We do want, I do want to spend a little bit of time today. I am the only actuary that is up here alongside Paul. And so want to hit unit cost and utilization specifically, as that does seem to be an area that I spend a good bit of my time in, but something also that Cigna, in the course of our coverage in Connecticut over the past couple of years, has really drawn attention to, with the rate increases that we've requested, and the actual cost of care that we have seen in the state. And so I want to just start by kind of defining exactly what I'm talking about with unit cost and utilization, as they often tend to be either misrepresented or misunderstood within the context of how we're thinking about them when we talk about the underlying cost of care. So the first component, unit cost, generally speaks for itself. It is the true actual cost of that care. So the price that a person is paying when they go to the doctor, go to a facility system or a provider. The second, utilization, it's the actual number of services that are being used throughout the course of a year. And so whether it's lab results or x-rays, inpatient procedures, et cetera, the actual use of those services. And the third and piece that has kind of fallen off of the utilization moniker is really the mix of services. And so the different types of services that are being used within the marketplace, including the site of care, as well as then any new technologies or procedures, and in the case of especially prescription drugs, new drugs that are entering the market. So we've consistently seen increases in the small group marketplace in Connecticut in both unit costs and then utilization and mix over the past couple of years, especially following the global pandemic in 2020. As Paul mentioned earlier, we did see decreases in that cost of care during the pandemic, but then following the pandemic, as folks returned to a sense of normalcy, they were behind in some of the care. And so we did see a pick up of the care over that 2022 time period. That led to increased cost over the past couple of years that we've then since reflected in our rates, and has been challenged in actually trying to keep that cost down as there has been that kind of return to normalcy since the pandemic. In addition to that, and something that JP had brought up earlier in his presentation, is a lot of the new drugs that have entered the space over the past couple of years. Not only gene therapies, which are addressing rare diseases that cost upwards of $1 million, $2 million, and have life-changing impacts for the patients that actually utilize those drugs. But we've also seen more common use of semaglutides, such as Ozempic and Wegovy. They are not inexpensive, and the utilization of those drugs over the past year, past 2 years, has increased, and we expect that utilization to only further increase in the future. Over time, if the premium that we collect to actually pay for the cost and then utilization of these services does not keep up with the cost that we are actually paying out to facilities, providers, manufacturers of drugs, it does lead to an untenable situation in the long term that causes losses for carriers and eventually can lead to the exit of them from the small group or individual market. As insurers, and I think I can generally speak for most, we strive to keep unit costs and utilization low in the market, not only from a competitive perspective, but also from an affordability perspective. We want to keep that total cost of care, and there are tools and methods that we use to try and keep unit costs and utilization low. First and most obvious of those is, of course, really pushing for better rates with providers, facilities within the state. But there are then, of course, other tools that we utilize on a daily basis, such as care management, which Paul had spoke about previously. utilization management tools to ensure that folks are receiving the best care at the right place at the right time. I do want to turn attention and really point out JP's kind of triangle that he had up on the page previously. So generally referred to as the triple aims of healthcare. So affordability, access, and availability. I do want to layer those pieces over that unit cost and utilization kind of component of how we are thinking about total cost of care within the state. I think JP had mentioned narrow network solutions. And so there are solutions that are available, but we should really seek to balance those specific solutions without damaging one of the specific legs of the triple aim. And so narrow network solutions, while you may aim to kind of remove a high cost facility or provider from the network that we have today, it could reduce the overall cost of care and improve affordability for members and customers within the plans. It then limits access or availability to those same customers that may have used or are using that facility or provider today. On the other side, tools such as prior authorization or concurrent review, they limit access and availability and are trying to ensure that customers are receiving the right care at the right place. In limiting those tools, you may improve your access and availability of the specific care that customers need, but at the same time, it then is going to increase your utilization of those same services and reduce your overall affordability. So finding a balanced approach to really further the triple aims of all three is a challenge, but look forward over the course of today to engaging within the broader discussion. And again, thank you for your time.
Thank you, Representative Wood and others for pulling together the forum and having the discussion. I don't know that I have anything more enlightening to add based on what my competitors have kind of laid out here. Aetna also is withdrawing from the small group market. We notified the department in March and have been working with the department on the process of unwinding our small group. We've been in the small group space for a very long time, but it's almost, in retrospect, you wish you could take JP and Paul's presentation, some of the comments here, and kind of align them all up. You have to have a product that people want to buy. You have to have a price point at which people can afford it. And the pool has to be sufficient to actually allow the product and the health plan to kind of stand up. And while it may not appear so, it costs money for any insurer to stand a product and a health plan up for which there's either declining or no membership. So Aetna has tried over the last number of years. We have tried tiered networks. We've designed products, but to really compete and to compete against United and Anthem and Cigna and Connecticut in the market, you have to have a differentiation. And we've not succeeded in that. So part of our business decision in terms of looking at risk and looking at where the market and the pools are was that we continuing to stand up products in the small group market was not going to be in our long-term plan. That is not, by the way, unique to Connecticut. We have looked across a number of markets across the country and are pulling out of the small group market in a number of states. So, but in preparation and in thinking about this forum, because JP laid it out, Paul has solidified that as well. This is not unique to Connecticut. A number of the changes in the Affordable Care Act did fundamental changes to the small group market. And we are living those in these last 10 years. And I think that Jeff and Julie and Wyatt can speak to this more so than others, but we talk about it as a market. But I went back and was looking at some of the QCEW data to understand who are the people in those markets. And in the small group, there are in Connecticut, according to the QCEW data, 60% of the employees are in small businesses which employ less than 20 people. And I won't speak to group of one, one of the big changes in the Affordable Care Act that upended a lot of sole proprietors. But 18% of Connecticut's small businesses employ between 1 and 5. I think Jeff and Julie can speak to this. A lot of those are family-owned businesses, and how those businesses purchase insurance is very different than an employer that may have 50 or 100, right? They are looking at their lens. And if you take some of what JP has laid out, if you own your business and you're aging, the rating factors in the small group market, they helped to socialize the cost across the pool. But there was a price to pay for that. And I just think about, as we think about solutions and we think about the actual people who are trying to buy coverage, they are going to look for very different things for very different reasons. So in a market that has been largely where the product design has been more standardized by the result of the Affordable Care Act rules, some of these businesses are looking elsewhere because they're looking to meet their needs. And they are in a very different point in their business than perhaps an employer that may have between 20 and 50 employees. We have found that our products are just not competitive. And it is the basis for why we made the decision that we did to pull out. But I do look forward to the conversation because I think that we think about the market. It's at 76,000, if that's what Paul's number is, and it was at 200,000. That's not that all those people disappeared. They are likely seeing and seeking coverage elsewhere. Some of those folks may have benefited from the Connecticut policy of expanding Medicaid. The coverage for all for children. There are very solid public policies to ensure that children have coverage. So they are pulling numbers out, but it does not mean that people are going without coverage. It's just that they're finding the coverage that works for them, not just at a price point, but at a design point that may work for them. So I think that it's great to have a robust conversation as to what this is and where people are seeking coverage and how maybe we can design things within the constraints of the Affordable Care Act and outside of that may be attractive for the market. So thank you for the opportunity.
Great, thank you, Maggie. At this point, I'd like us to have a roundtable discussion on a path forward. And I would like to just reference JP's slides on the good news of Connecticut is that we are paying for good quality care. We have a very low uninsured rate, and we have a healthy population. I think the ranking was 4th in the country. So with that, and with the presentations that we heard from, how do we move forward? I have a ton of questions, but I'd really like to hear the boots on the ground perspective from the brokers. And I'd also like to hear from Jeff Hogan after that. Julie and David, do you want to have any comments?
Good morning. My name's David Richmond, and I have been a benefits broker in Connecticut for 38 years. I at one time owned one of the largest employee benefit agencies in Connecticut, which was sold 16 years ago. Today, we only have 23 clients in Connecticut. I predicted this was going to happen 3 years ago. When I started in the business, there was 12 carriers offering fully insured plans to small employers. Today, there are 2. And why? Because the risk pool is to blame. The definition of insurance is to spread risk, good risk, excellent risk, and poor risk. When we give small employers the ability to self-insure with level funded plans that are all underwritten, which means unless you're healthy, you're not going to get a level funded plan, which means you're going to stay back in your fully insured plan. So what's happened over the course of 2 years is all the good risk has left the fully insured marketplace. Why? Because the carriers have provided a tool to give the small employers a refund or a rebate of their premium if their claims are good. The problem is once their claims, when you're self-insured, which many of these small employers are doing today, until they have large claims, We just went through, here's an example. We had a small employer in Glastonbury, Connecticut with 6 employees that was insured with Connecticut for 5 years, and we switched them to Allstate a year ago. They had 1 employee out of 5 who had significant claims. What did that mean? They got a 37% rate increase. When we looked at the fully insured market to put them back in, the rates were the same. Why? Because again, we're taking all the good risk out of the fully insured market. The carriers have done this, not the employers, not the brokers. So the concern is allowing small employers to level fund, which is a form of self-insurance. Once their claims reach a certain level, they're going to have to go back to the fully insured market. Or you have employers that have a lot of claims. Small businesses have 1 person that is on $3,000 a month prescriptions. They're locked in. So today they have Anthem and United. And going back to Cigna, which one of you represented Cigna? Cigna bought business for the last 5 years in Connecticut with Oscar. They were the lowest premium in the marketplace. We love the product. Our clients love the product. Why? Because of the premiums. Most small groups, and I'm just tell it like it is, buy health insurance based on the premiums, based on the cost. They don't care about the network. They care about the cost and if they can afford it. So with raising cost, what's happening is you're having fewer companies offering ancillary lines today, dental, disability, vision. Why? Because employees cannot afford it. Last but not least, I would say that what we've seen lately is with increasing premiums and increasing cost, most employees are starting to defer care. Why are they not having their physicals? I think one of you mentioned it's a free benefit. Why don't they use it? Because they don't want to be given bad news that you're going to have to go on a prescription. You're having. And so what happens is they wait, and then we have a shock claim and they're brought to the ER because they've now had a diabetic seizure and they never knew they had diabetes. So it's time to make some changes in this state. I also have I live in other states. I work in other states. This is one of the worst markets we've ever been in, ever. And level funding created this market. And if that's not true, I'd like one of the carrier reps to tell me why it did not. Thank you.
So we're going to have a little difference in opinion, I think. Employers want to offer quality healthcare at an affordable price, not just affordable when we're talking about contributions coming out of their paychecks, but also affordable when they do have to go to the doctor and get a prescription. I mean, I look at claims all day. It's not the insurance company's fault that pharmacy claims, one pharmacy bill, $12,000 a month. I mean, I don't know what it's for when I'm looking at these claims at the broker level, but $12,000 a month for pharmacy just seems ridiculous. And they need to have other options. Level funded is important, I think, in this market, especially now that we're only down to 2 fully insured carriers. And the problem is, if you're not going to go the level funded route, there's the PEOs, there's the captives, there's so many other ways that are doing things to that small group market, not to mention the individual market. The individual market is subsidized. So now you have employees coming out of that small group market because they're getting subsidized to buy individual coverage. So obviously, if we knew how to solve this problem, we would be millionaires because it's a huge problem. But I talk with other states. Maine, what they try to do is pool the individual and the small group. It's not working. They also, I think, did that in Massachusetts, also not working. So please don't do that. Let's learn from our neighbors. But I just think we do need to look at these alternative coverages. And yes, what I've also seen is we've had people go into the level funded market. They've gotten 25% rate increases. still better than the fully insured small market. So they're doing something right in certain areas. So obviously I don't have that magic bullet, but I do think we do need to look at those.
Jeff?
So I've been in healthcare for 40 years, so I'm old, 4 grandchildren now, and it's scary to look at the trajectory of healthcare costs. I remember when I started in the business, the healthcare consumption of GDP was about 12%, and we're now 18 going toward 19%. So a lot of good comments today. The leadoff comment was really important. I worked with brokers and consultants and employers for 30 years throughout New England. I literally worked on thousands of groups over that period of time. In my first retirement job, which is now, I get to work nationally, mostly on the supply side of healthcare with providers and clinicians and health systems and things like this. And I think this is really an important thing as legislators to think about. We talked about affordability. We don't spend enough time on the trajectory or the cost of healthcare. And I remember right when COVID hit, I got to work with Vicki Veltri on a project to drag Connecticut's all payers claims database information into the RAND hospital transparency report for the first time ever to show the huge variation in cost and quality between health systems in Connecticut. It's huge. And the problem is, and this really is a problem, that nobody knows what anything costs. If you're an employer and you're financing knees and hips and babies and shoulders over and over again, and that knee should cost $22,000, you should know that it should cost $22,000. And in Connecticut, there are systems that charge $100,000 for that. So in 2021, a piece of federal legislation passed called the Consolidated Appropriations Act. And basically, what does it say? It says every employer, small group, middle market, large group, fully insured, self-funded. The employer, one person there, is the named fiduciary and must know what things cost. And they are obliged by law to act only in the best interests of their plan beneficiaries. So this is kind of a weird thing, as far as insurance goes. It says that that employer is responsible for knowing what his or her employees need or want. That's a really unique thing. In the past, we will go out, we'll buy a fully insured plan, hope it works, even if it's 30% more expensive than what the rest of the marketplace is looking for. The point is here, employers in Connecticut and other states have voted with their feet, and they are moving to products and solutions that are in the best interests of their plan beneficiaries. It may be level funded, it may be self-funded, it may be a captive, it may be some variety of this sort of thing, but we can't ignore the fact that employers are now responsible for understanding the costs that their employees pay. In the small group marketplace, employees pay up to 50% of the cost of those premiums. It's different than in the middle market and the large group. They're paying up to 50% of the cost. So as legislators, I'm in a small group hearing today. It's the same old thing we said in your committee meeting back during the regular session. We have done a poor job in this state showing people what things cost and to help to show that to the marketplace. Somebody said something about Maine. Go on comparemaine.org. Someone with a $5,000 deductible is going to have their knee done, or they're going to have an x-ray done or an MRI done. They can go on and find out what it costs beforehand. Costs matter. They're driving these increases, be it in the fully insured or the self-funded marketplace. people actually like the level funded or self-funded contracts because they get data about where their people are going, where there's bad quality, where there's infections and things like this. And every carrier here has invested and purchased advanced primary care assets at this point that are being deployed in other states at this point to take accountability over these costs on behalf of the employees as well. So just really want to drive home the importance of focusing on healthcare costs and the impacts that they're having, be it in fully insured or any other types of insurance, particularly to small group employers whose employees pay the majority of those costs. Thank you.
I'm going to open it up for anyone to respond to those comments. I would like to ask Jeff a comment that I was at, I think it was the cost growth benchmark informational forum. And the comptroller's office is doing exactly what you said. They have 255,000 lives. So of course they are looking at making decisions as a fiduciary in the best interest of those lives. I don't know if a 5-person employer is able to do that. And I asked the comptroller's office, is that a path forward to have the comptroller kind of put forward a best practices? Because how are these, 50 and under, 25 and under employers supposed to be a fiduciary and also a bookkeeper and also the HR department and all those other things?
That's a great question. So thank you for that. And the comptroller's office has shown a lot of leadership over recent years with the state of employee plan. There's a value-based plan. And if we look at it going back now 6 or 7 years, they actually created advanced primary care as an aspect of that plan. The person going into that plan chooses advanced primary care and can steer and has options for episodes of care. So it's a supply side solution that small employers, middle market employers can also use. Basically, what's happening in that situation is that the employee is using a practitioner to help them steer longitudinally through all of their care, which includes coordinating specialty care. It may be ambulatory care as well. Back to your cost growth benchmark for a second. So last month, I got to moderate a panel with the Mass Health Policy Commission, probably one of the best in the country that really studies cost, quality, systems, and things like that. They started this cost growth benchmark movement. And the gentleman who runs data for the Mass Health Policy Commission said specifically that they were able to embarrass systems for a period of time, but then that stopped. Namely, the hospital inpatient, outpatient last year went up by 15% in Massachusetts. But now they are also focusing on this whole notion of advanced primary care right down to the small group level. Why? Because that takes the risk away from the employee and helps the employee to navigate the system in a responsible fashion.
Representative Meskers?
When we talk about the structure of insurance, the price transparency is obviously a major issue in both competition and a major issue in accessing healthcare. I mean, I spent years in finance and I still don't know what any procedure costs. And I'm not sure who to call or when I'll ever get an answer. But there are two issues with that. There's a lack of transparency in the costing of the structure of healthcare, particularly in the insurance, in the hospital care. But the structural impediment is also a medical loss ratio. There is no incentive for lower costs in the structure of an MLR. And that drives healthcare costs as well. There's no incentive to the insurance companies to drive down costs other than to keep their patients or their clients paying healthcare premiums. But if every dollar is with a medical loss ratio, every incremental dollar is an income. And we don't have an incentive structure right now to drive costs down. So we defer to this. I don't know what structurally we should be doing there.
Yeah, it's a great question. And you have to go outside of Connecticut to see how transparency is suddenly being a thing and becoming actionable. I was just in Texas, and you see in the news the Mark Cuban cost plus thing. So what is Mark Cuban doing now with his fame and fortune? He's embraced healthcare, and he did cost plus with drugs, and it's becoming more popular, but now he's moved on to other things, hips and knees and babies and shoulders, and creating a marketplace incentive for these things. So the ACA MLRs, it was a disincentive, actually, as you say, absolutely correct. And unfortunately, and I used that term before, this is why employers have kind of voted with their feet to move to platforms that show them their data and analytics and don't oblige them to MLRs. And even in the Connecticut marketplace, the carriers have developed competitive products, even if there is a large claim that blows up a case, that they socialize those increases. For the most part, the carriers that are sitting at the table here, why? Because they want to keep that group for as long as they can. The fully insured marketplace has been a game of whack-a-mole in this marketplace for 10 years. Who has the risk this year? Who gets it next year? And it's been commoditized. But the incentive with the plans where there aren't MLRs is to keep that group, to keep the employer involved. And we are seeing in other markets, I helped to work on the state of New Jersey health plan with 800,000 employees, and they're using their breadth and scope to impact the smaller group markets as well.
Just as a follow-up, in that 800 group plan is looking to establish clearing prices for hospital procedures, et cetera, and offer it into the small group plans?
Yeah, it's a great question. So what they did, it was actually the unions who incentivized it in New Jersey, because there was little competition in that marketplace until they finally saw what they were paying for hips and knees and babies, and the OPEB liability also scared the legislators from a healthcare point of view. And suddenly that caused them to introduce another carrier into the state for July 1st effective dates, and to encourage these hospital initiatives, particularly ambulatory surgery initiatives. Why? 52% of your costs are inpatient, outpatient. So if we can save 30% on ambulatory. So we're starting to see the marketplace get, because of these signals from the big purchasers, dictate the types of things that people want to see using transparency.
Lou?
Yeah, I'd like to add a little bit on unit cost and utilization, because it's an important part of the problem, right? There is a lot, when there's a complex problem, there's not one solution. It's not like, hey, let's do this and everything's going to be solved. But unit cost and utilization is going to be a continual part of the equation and discussion. And one of the things have to do more of in this state, given the dynamic of the network in this state, right? It's a few large systems that we work with. And we need to drive more of the MLR based outcome payment, right? So I know that's been an endeavor. My friend Jeff and I have talked many times. It's been one of our biggest priorities at Anthem, is to drive value-based contracts. And we've had some success, but albeit we need to do more, right? We have 67% of our medical spend is in some type of risk contract. 43% of our medical spend is in value contract. 43% is in a risk contract. What does that mean? That means it's based off of the MLR, and there is risk sharing between the payer and the provider. That's great start. It's not, it helps. There's some good results. Increase in medication adherence in those programs, 6.5% increase in breast cancer screening, 7.1% increase in colorectal cancer screening, and 7.7% increase in well child visits. Those are all from our enhanced personal care health program with providers. That's a good start. That has to be a cornerstone of our initiative on unit cost and utilization. Once we do toggle the majority of spend on MLR, that's when we start changing the dynamic. We can't have a fee for service based system, especially in this state. It's just not going to work. So I think it's important to spend a lot of time concentrating on what we can do together as a state to drive incentive toward those value-based contracts. There's other parts of this too. We talked about, there's other parts of this problem. We talked about taxes, assessments, mandates. That's real dollars, right? Mandates alone adds 1.3K to every policy in the state. Taxes and assessments across all segments, according to CBI's last study, 2,000 per policy. So that those are real things that we just have to understand and talk about. Are there solutions there? And then, but those are big drivers in the fully insured space.
Next up, we have JP.
Yeah, I just want to make a brief point, and that is network adequacy is a piece of this, right? And that remains part of the concern. You see time and time again, contracts between providers and insurers across the country go down to the last possible second. I appreciate both Representative Metzger's joining the bow tie brigade as well as his points. But I think the hard part is the incentive for the insurers is to make sure that they're following those rules, that they have access to those providers. I don't think it's just the MLR that is having an impact on their negotiations with the hospital systems specifically. Part of it is a system. There are disincentives certainly in an MLR system that you can't push more money towards managing the care, that does not in fact count towards the MLR, that those have been separated both under federal rules as well as under state rules. State rules are consistent with the federal rules. That remains an issue and a concern, but it's not just that there's a purely a disincentive there. There's also other laws, rules, and regulations that create those problems. So thank you.
Madam Chair, is this being opened up to questions from legislators?
We will add you to the list, Senator.
Yeah, I just want to follow up on the commentary I heard about Massachusetts, the fiduciaries, best practices. And I want to pose the hypothetical, what one or two things could we conceivably do and bring to Connecticut from your experiences that would A, improve, and B, save money, and C, make things affordable? Ambulatory surgery centers are obviously a tremendous cost savings based on what they can do there and based on, and I'm going to take and walk out on a sort of walk above the sharks for a second, and how much money can be saved as opposed to a hospital setting and the costs there, having some recent experience with that. The point being, and I'm circling back to my original question, what one or two things could we conceivably do here to A, make things better, and B, save money, and C, make healthcare more accessible? Because I think that's probably the real route where we need to be. How can we make it more accessible, more affordable, and more practicable to the folks that need it?
It's a really good, important question. And if you look at what the biggest companies and state governments and Taft-Hartley union groups are doing right now, they're focusing on two areas, pharmacy and hospital costs. These are just huge, out of control areas, even for small group employers, be they fully insured or self-funded. The highest fixed cost in their plans is for what they pay for stop loss. So these big things, if it's CAR T or a gene therapy or something of this nature, that's going to whack the stop loss every time, that's going to get passed along to everyone that's in the group. So certainly specialty drugs is a big problem. Roughly 2% of an employer's population consumes those specialty drugs. And it's about a 50-50 split between PBM and medical pharmacy, basically what the hospital is charging for those things. So if we were just to look again, this ambulatory strategy, we've seen companies move into the state to do freestanding infusion. The effect on reducing costs to an employer just doing freestanding infusion is huge, including on their stop loss as well. So the Massachusetts, for example, has done a terrible job with ambulatory assets. Why? The hospital lobby was very strong. And the big companies, the Fidelities and what have you, they send all their ambulatory to Southern New Hampshire. It's crazy, so kind of understanding those things that will help employers, including understanding what the costs are, creating that marketplace. Our all payers claims database is a disaster for an employer. We don't have enough contribution. We don't have enough employers voluntarily participating to see what things cost. And for those who want to use it to see what they do cost, it's very, very difficult to search it. It's not approachable for employers or for consumers either.
So how do we get to the point where it becomes understandable on what those costs are?
Yeah, that's a huge question. If we had another 2 hours, so the answer is, and we're seeing this in other states, New Jersey, we're starting to see it in Massachusetts. We see it in Maine and New Hampshire or what have you. It's getting health systems to compete against each other with transparent costs that people understand. And there's a lot to that. I said the all payers claims database. How do we find out what those costs are and get them to a consumer so that they can make choices? It's a combination of health policy, searchable databases for costs, and also health systems who are doing direct to employer initiatives. This is becoming a thing in almost every state where a hospital goes in to an employer and says, we'll take the risk away from you to actually encourage those types of value-based arrangements like Lou was just describing as well.
Wyatt?
Thank you, Representative. I think before we even get into the solutions, it's really, really important, going off what Lou stated earlier, for this legislature not to impose any more harm onto this volatile market. And by that, I mean mandates and assessments. It's something, a lot of people groan when I mention it. It's mentioned a lot, but it has a huge cost impact on fully insured participants. So number one, mandates. There's over 60 health benefit mandates in the state, right? Above and beyond what the Affordable Care Act mandates these plans cover. Some of these mandates come in the form of, administrative. So for example, changing the way step therapy is done or utilization review is done. Some of the mandates come through in terms of capping cost share on certain services, right? All of those mandates impose costs on the lives that are enrolled in those plans. What's interesting though, Connecticut is one of the only states in the country that does not actually review the cost of those mandates prior to passage. So what do I mean by that? In Massachusetts, right, the beacon for all things health insurance and health analysis, there is a state law that requires any mandate, proposed legislation with a mandate, to receive a cost benefit analysis before it can get out of its final committee. I believe it's the Appropriations Committee. That forces the legislature to look at the cost that they will impose on Connecticut residents before dealing and passing the mandate. In Connecticut, it's completely optional. There's a process under state law. The last time it was utilized was 2014. So Lou, you mentioned that report we did. I can't even credibly talk about that report anymore because we don't have the recent information on cost. But back in 2018, right, $2,000 with assessments and mandates. It sounds about right. So I would heavily urge the legislature from, I represent 95% of our members are small employers under 100 employees. We're the ones being dinged by these increases every year. We have to get a better understanding and have a grasp on what these mandates cost prior to passing it. And I'll give you an example. OFA recently started doing a fiscal analysis for mandates as they are applied to the state employee health plan, because the state employee health plan voluntarily covers the mandates. And there was a mandate, I believe 2 sessions ago, that said it would impose a couple $100,000 on the state plan and thus be an impact to the state budget. Bill died. The legislature said, oh my God, we're going to put this on the cost of the state. We can't afford to do this. Well, let's make sure we have that same fiscal note for private plans as well. And on the point of taxes and assessments, right? So, when I say mandates and assessments, these are the 2 big things that self-funded employers do not have to deal with. When they go to the self-funded market or level funded market, they don't have to pay the premium tax, which is $202 million a year, half of which comes from health insurance companies. The average cost to a family of 4 is about $740 annually. The exchange fund assessment, $32 million, average cost $244 to a family of 4. And what's amazing about the exchange assessment, right? You can think about half of it is paid by small employers, 99.9% of which are off exchange. They're not on the SHOP platform. They're funding Access Health Connecticut, but Access Health Connecticut isn't doing anything for them, right? They're not enrolling people like they are with the individual market. They're not, they don't have customer service people dealing with small employers, but small employers somehow are funding the exchange when the vast majority of them purposefully do not buy exchange products. So I would say, what is the point of having off exchange small employers? The 70,000 Paul mentioned, what's the point of having them pay $10+ million to fund an exchange they don't use? And that would be a huge, huge burden lifted off of a lot of families and small employer fully insured plans. So before we even talk about, ICRAs and captives and MEWAs and all that stuff, we need to really get a handle on costs and be serious about the mandates that we're passing, right? Because they don't affect self-funded plans. Self-funded plans cover a lot of the stuff Connecticut requires, but they may cover it at different levels that match the needs of the employers that use them. And as Jeff said too, employers have a responsibility under the CAA, personal responsibility, to understand the cost of these mandates, understand the cost of assessments. And if they can get a better deal in the level funded market, they're going to go. And if they don't go, they will get sued. So just 2 things I'm kind of throwing out there, to really not do any more harm to a market that's really on the verge of collapse.
Thanks, Vi. I do want to comment to that, but we have a long list of speakers that I think will get us to the end. So let me work our way through that. Next up, we have Senator Lesser.
Yes, thank you. There's been a lot of talk this morning about the ACA. Obviously, the ACA is national legislation that applies in all 50 states, but the current death spiral in Connecticut is really specific to Connecticut. And so I think one of the frustrations about this conversation is that although there have been some talk about this Connecticut specific situation, there's been not enough about what other states are doing and what has worked and what isn't working, because I don't believe that the death spiral in the small group market is a national situation. Others may disagree. Someone mentioned merging the small group and individual markets is something that had failed nationally. Looking at the statistics of Massachusetts, I'm not sure that that's the case. Their enrollment on Mass Health seems to be quite strong. Other states have, I think Wyatt just mentioned, ICRAs or QSARAs have looked at HRAs as an option. Other states have looked at, I know we do have, a lot of folks have mentioned that there aren't subsidies of small group insurance. Of course, that's not true. There are subsidies through the tax code, but other states have taken steps to solidify the existing small group marketplace, and Connecticut has notably not done that, either through insurance or other forms of state-based subsidies, nor have we addressed some of the specific pulls that are pulling people into the self-insured space. We could have basic consumer protections for small companies that purchase stop loss plans. We don't at the moment, and that might also reduce the pull into that space. And lastly, we don't really have a policy designed to address the barriers that smaller carriers and new market participants have to entering the market. The ability to have access to standard a standard network that would be available to a small carrier other states like Colorado have taken those steps. My concern is, rather than focus on strengthen the small group marketplace, and hopefully this is a first step to doing that, the legislature has instead taken a different approach, which is to blow up what's left of the small group marketplace. And I think that that's been a misguided approach. So I'm hoping that we can, recognize that whether folks would have voted for the ACA in 2009 or 2010 or not, it is a national landscape. It is not resulted in a collapse of the small group space nationally. But we can address some of the Connecticut specific problems in the legislature, or continue to choose not to. And I'm hoping that we'll do the former, not the latter. And I don't know if anybody wants to comment on that, and specifically, what we can do here to strengthen the marketplace rather than blow it up.
Yes, you want to make a comment?
Yeah,
Zach?
can I just make a quick comment? So I agree with the commentary. I think it's good to recognize that the ACA fully insured marketplace was created on a national scale. And there are challenges that exist on that national scale that then also translate into Connecticut, into each of the states where there is a challenged small group fully insured marketplace. As you know, Cigna plus Oscar is exiting this space. And David, I know you called out Cigna plus Oscar specifically in early years. In Paul's commentary earlier today, he did make note of some of the challenges of client carriers entering the small group marketplace, where you do not know the risk up front that you're actually going to take on. And after that first year, the second year, when you're going to price your third year of premium, that is the first view that you get into your actual experience period. And the morbidity and risk adjustment associated with that experience period that then drives the rate increase and the premiums that are being charged back to the consumers of the plan. There are a number of national challenges that then come out of that. One of those being the risk adjustment program, where there is a durational impact for new entrants into a specific market. And so the way that the risk adjustment program today is structured by CCIO and by CMS is really based around the individual marketplace, where individuals that come into the marketplace have a 1/1 effective date. They enroll through the open enrollment period. And even if they are coming onto the books on a special enrollment period later in the year, they're still on a calendar year plan where they have to renew for the next calendar year on 1/1. The small group marketplace is very different from a fully insured perspective, where we have plans that enroll throughout the course of the year. They can have a 1/1 effective date, a 7/1 effective date. We even see a sizable number of our Connecticut plans in the state with a December 1st effective date. what that does is actually challenges the risk adjustment program in your first year, in your second year of being in the market, in the sense that you don't have as much time to actually submit claims and codes to CMS, to then capture the risk of those folks that may join the plan in December. And so you're penalized for those specific members when you're first entering the market. Now, in the next year, you have 11 months of them on the plan. And so you're actually able to capture more of the underlying risk that those members bring. And risk adjustment is then supposed to balance that risk between carriers. But it is an issue, and we can see it in Connecticut, especially with exits, and the fact that it does not foster an environment in future years for new carriers to enter the market when they knowingly will be impacted in a loss position early on in their experience within the actual state.
Thank you. And I have a question for David Richmond, if I may. I found your testimony to be really interesting, and we are obviously limited by ERISA in what we can and can't do with regard to the self-insured players. But recognizing, listening to what you're saying about some of the potential problems with the level-funded plans that are out there, are there consumer protections that we could apply to stop-loss products that would mitigate those effects? Is there something we can do to provide some protections to lessen the risk that we're shifting onto these smallest employers?
No. You can't do it under self-insured plans.
You regulate stop loss. So stop loss, other states have put in no laser provisions and some other, and the department's very familiar with this. They looked at it when they came out with their memo 7 years ago, I believe it was. Yeah.
Thank you. Representative Denning, did you have a question?
Yes, thank you, Madam Chair. I have a question during the past meeting that we had with the cost growth benchmark, we learned that Anthem is no longer going to participate. And I wanted to know if they were willing to comment as to why they would not want to continue to share that information.
No, we are participating. Did you mean Aetna?
So you did not withdraw from participation in the cost growth benchmark? Okay, then I will pass that information back along. Thank you very much.
Thank you, Representative Meskers.
So just a couple of observations and probably a question in the process. So first, while I think we do need to look at costs on mandates, where I step back and look at the mandates is obviously in some cases there's good policy behind the mandates. In some cases, in all cases, there should be a cost benefit analysis. But reducing or eliminating mandates is going to still take us on the course of a baseline compounding of, I guess, about 8% on hospitals, about 12 to 14% or more on pharmaceuticals. So once I get the initial benefit of reducing mandates and lowering healthcare costs, my compounding at 8 to 12% a year is going to double my insurance premiums in about 6 years, maybe 5. My math's a little rusty. But if you double healthcare premiums, we're going to be left with no option, but the government assuming all of the risk premium. Right now, when we talk about the Affordable Care Act, which is, what's meant to give people coverage, the one thing it didn't do was provide us with what we're having a discussion of today, which is how do we make healthcare affordable and accessible? So one way is through government subsidies, but without cost constraints, those government subsidies just take some of the pressure off the ability of pass-through costs, whether it be from hospitals and pharmaceuticals, to send it on to the general public. So we don't have a good control of costs. I think we're beginning to talk about the measures we can get there. And lastly, one of the measures brought out by some of our colleagues, I believe a year or two ago, was the idea of us issuing a stop loss in policy or insurance stop loss to try to reduce healthcare premiums. So being the state, being a person to look at underwriting, and that wasn't from your department, but I think it was coming out as policy. I think it takes us to the same problem, and I'd like an observation or comment on that. If I do underwriting of a stop loss, and we don't do any of the things we're doing that we talked about in terms of cost controls, does it really achieve much of anything other than shifting an overwhelming burden now onto the state without doing something? And that's my real. I was looking forward to that as a possible solution of underwriting, and does it help at all, really?
There's actuaries and underwriters that have more expertise, but what I've seen in the past is that there are middle market employers that are self-funded and small group employers that are setting up reinsurance arrangements for specific types of risks, maybe orphan diseases, things that if they hit the plan would be an atomic bomb. This becomes a sharing mechanism. So there are advanced reinsurance mechanisms that can be used for specific types of risk that smaller middle market employers would really get blown up by. Actually, many of the Fortune 500 companies that have huge credibility on their books of business suddenly are starting to look at reinsurance mechanisms for certain types of risks as well. So it's got to be designed appropriately and tactically.
So you think it still could be a potential partial solution to laying off some risk and reducing premiums?
Devil's in the details.
And if I may, Representative Metzger, I would note that when you look at subsidies, the impact of subsidies is not just a one-time sort of impact on premium. There is an impact by lowering the premium that it attracts more favorable risk broadly into the risk pool. We saw this in Wisconsin when we studied it and looked at the subsidy program for the individual market. The same would apply to the small group market. When you look at it, you have a multiplier effect that lowers the premium overall over time, attracts more favorable risk, gives you a more favorable risk pool, and as a result, results in lower overall cost to the market. I would also note, I've got a slide here I'm just going to show briefly related to the issue of the merged markets. I don't think the merged markets have been as successful as people necessarily think. There's been a couple of studies on this related to it. I would note that Vermont, in fact, unmerged its market as a matter of course. When you look at Massachusetts, they recently issued a new report on it. They indicated that there would be a 2 to 4% decrease in overall rates if they unmerged their markets, and it would have a multiplier effect over time. District of Columbia is different. They did this for looking at their the individual market in and of itself. Because their individual market was so small, it was not viable. Maine just recently merged the market, and they did, in addition to providing subsidies, they did in fact find that there knew upfront that there were going to be increases. And also note, North Dakota did a broad study of it, and they found there are 2 carriers in their market. In the individual market, it resulted in lower costs by both Blue Cross Blue Shield and Sanford. But you can see in the merged market, it results in increases in the small group market. So the impact is net positive for the individual market because they offlay the costs onto the small group market, which tends to be a little bit less expensive. Happy to answer any other questions. Thanks.
I have myself on the list next, so I'm going to let me just jump in for a second. And then we'll do Sue Halpin and then Wyatt to end. But I do and if there's any comments in between, we can certainly do that. There was a question of what are we doing to make sure that the fully insured market in Connecticut does not blow up. And some of the things that our committee has been working on over the past few years, we put forward a premium tax reduction that did not move forward. We passed a mandate review in the House that was not taken up in the Senate. Since that time, a mandate was passed to remove prior authorizations for autoimmune diseases. I don't even think we know how much that mandate is going to cost or how we even get our arms around that, but I can only imagine it's extremely costly to that market. We have put forward a pooling plan to allow the small group to pool and grow the fully insured market. That was fought fiercely in this building, yet supported extremely well every forum that I went to in my district. Regarding the assessments, we have an insurance fund working group that did pass the appropriations committee that many of us are on to look at that because we have heard the concerns from the industry that, you know, we do need to take a deep dive into that. But we are looking for solutions. We are putting forward solutions. We are met with lots of opposition. But the goal of this forum and hopefully future forums to have these candid discussions is to keep having, you know, the solutions put on the table and see what we can get past. There's no silver bullet with any of these. This is a very complex market, but to make sure that the fully insured market does not crash and burn is a goal of this committee. And many of you have offered, you know, great suggestions that we will continue to work on. And would like to be working with the department, you know, together on a lot of that stuff as well. Thank you for being at the table with us. We have Sue Halpin next.
Just a comment. Yeah, I think we've done a fairly strong amount of work on a lot of the issues. I don't want to hijack the meeting, but any of you in terms of and thoughts going forward, I'd love as a member of the insurance committee, thoughts on stop loss, whether it be for the fully insured market, the self-insured market, potentially for our estate employee. If we look for a stop loss out, you know, a global underwriting there to take care of some of the cost risks. And if you think it's valuable, we'd love to hear feedback in the future. I don't think I want to take this today, but thank you.
Just to clarify, are you talking about a reinsurance scheme? Is that what you're, when you say stop loss, is that what you're talking about, Representative?
I'm basically talking about laying off catastrophic risk and the question of how if it would feasibly work to reduce premiums. Yeah. So the terminology, whether it's a stop loss or reinsurance, it's basically to cover extraordinary risk, whether it's on the state plans or in the private sector, if there's something we could do, or whether that's already fully covered in the private sector with their layoff of risk. Thank you.
Thank you. Representative Wood, I think you stole my line about there's no silver bullet, although I know we all use that line regularly in this building. And I think it is very true in whatever sense it's used. We had a lot of conversation today about cause and effect. And no matter what you're talking about and all of the ideas that have been circulated and discussed today, there's going to be unintended consequences. And I think if the one cautionary note I could add to this is that we fully explore those unintended consequences before making any major policy changes. I want to echo a lot of what Wyatt talked about as well in terms of the mandates assessments. We're having a lot of conversations in other committees and other councils about healthcare costs in general. But going back to that cause and effect, when you have a Medicaid market that's reaching 1 million members, and the studies that have been borne out about the sufficiency of the rates paid to providers in the Medicaid system, you can't help but understand that there's a cost shift and an impact to the commercial market in terms of healthcare costs. So I think that's the one thing that I did not hear mentioned today that I just wanted to, you know, put on the table. These are huge issues, you know, and it's going to take the great minds sitting around this table and others to come up with those solutions. But I guess, you know, whether it's the mandate review, we're not talking about traditional health mandates anymore. We're talking about structural utilization review, cost management, care management mandates now that are being put on the books. And we talk about the rising costs on pharmacy on the one side of the issue, and then the legislation that we see come across for final passage restricts any ability to manage or some ability to manage those costs. And we're not recognizing the connection and the cause and effect between those two things. So I want to echo the first do no harm. I wanted to broaden the conversation in terms of the impact of the one market on another in terms of Medicaid increases. And then just to echo, I think some of the things we've talked about advanced payment models. And that is going to be a solution I think that all the carriers are looking towards in order to get buy-in from the provider community, from the consumer community, from everyone. We can't continue to be on a sustainable basis of a fee-for-service reimbursement system. So just wanted to throw out those couple of things as we wrap up here. Thank the chairwoman and all the members of the insurance committee, and the department, as well as the participants today. I learned a few things, and I think it's really helpful to have this kind of exposure and educational forum for others to learn about the complexity of the system before us. So thank you.
Wyatt, final words?
To your point, Representative Meskers, about a reinsurance program. They have worked incredibly well in the individual market settings across the country. In fact, I think every reinsurance program in the country is dedicated to the individual market. It's like that because the state, or if they assess plans to cover that pool, a big portion of that investment is given back through pass-through funding. So the federal government says to the state, if you can reduce the cost of healthcare on the exchange, thus you would decrease the cost of the federal subsidy going to market participants. The state captures those savings back, right? So the plan doesn't pay for itself completely, but the Wakely study commissioned by Senate Republicans, I think, or the Access Health, I forget, a couple of years ago, shows that if the state puts $25 million into the plan, right, they get 15 million back, and then you'd have to deal with that 10, something like that, right? You don't have that in the small group market because there's no subsidies. So that's why I don't think any state's done that, because it's incredibly expensive without the pass-through funding. So it's one thing to keep in mind. Plus, you have to make the decision whether you want to assess the carriers to pay for that program, which is what a lot of states do, or you make it a general fund allocation and have the state pay for it. So a lot of decisions to make, and there's no pass-through funding, so it's 100% state dollars or 100% carrier dollars. To tax credits, you know, there's really no tax credits for businesses stateside that purchase small group coverage. There is a SHOP credit, that's a federal tax credit. That only really benefits the smallest of the smallest employers, right? So employers with fewer than 10 employees with, you know, pay on average 27,000 or less. That's kind of the wheelhouse for that tax credit. But we've seen not a lot of people buy SHOP coverage, right? There's like, what, 1,000 members, 2,000 members in those plans. Most of them are off exchange. This tax credit has nothing to do with the small employers who purchase health insurance from Anthem or United or Cigna. So certainly I think tax credits are an option there. ICRAs, Senator mentioned ICRAs. You know, I think when you look at the micro employers, so like the 2 to 5s or the 2 to 10s, the employers that have trouble getting underwritten in the level funded market, the employers that are playing whack-a-mole, going back and forth, right, that aren't that big, don't have the scale to negotiate. A lot of them, I think, they're dropping coverage, or they're going to move to an ICRA or a QSERA model where they simply say, employee, I'm giving you $500 a month. Under new federal rules, that employee can take that $500, go to the individual market and purchase coverage and then get reimbursed for their medical expenses. They can also pay for their premium out of that pocket as well. The problem with ICRAs, though, is that if the plan is affordable and the employee takes it, the federal subsidy, or I should say the ICRA amount, is subtracted by the amount the federal subsidy they receive. So what do I mean by that? If the employee receives $500 a month from their employer, but they get a $600 a month subsidy from the federal government, right? The federal government's going to take that $500, right? And the employee's not going to have anything left in that bank account. So, I think something innovative the state could look at and really targeted towards those micro employers, 2 to 5, 2 to 7, 2 to 8, is some type of program where you could maybe layer employer dollars on top of the subsidy that the employer receives, similar to the way that Covered Connecticut works, where the state layers money on top of that, and individuals below a certain FPL can get enhanced subsidies for their coverage. It's possible for the state to set up a program where the employers could essentially contribute money to an account, and then that money could follow their employee to the exchange, where then they could get subsidized coverage and then use that money on top of what their subsidy would be, right? That's innovative, I think. No other states looked at something like that, but I think that's one way you get around the deduction of the ICRA dollars from the subsidy amount and let employees use that money on top of the subsidy they receive. One last point too, there is a huge disparity between what large employers are able to do and what smaller employers are able to do. So I was on the Kaiser Family Foundation. They do a yearly employer survey. It's a great survey. I highly recommend everyone looking at it. And one thing that really stuck out to me, I didn't know this, but firms with less than 25 employees paid 7% more in premium than firms with between 25 and 199. So that's single coverage. And then firms with more than 5,000 or more employees paid $12,000 less, or 12% less in premiums than firms with less than 25 workers. So that goes to this whole debate we've had over the last 5 or so years about building scale, and employers are thirsty to build scale, whether it be through a captive model. For example, the state has very beneficial captive laws with low capital requirements and good collaboration between the department and the business community. We've seen public options raised as a way for employers, small employers, to gain scale under the umbrella of the state employee plan. As a counter to that, you've seen the business community's proposal to legalize multiple employer welfare arrangements for employers to, instead of using the state employee plan as an umbrella to build scale, they use an existing trade association or chamber of commerce to do that. Those are legal in the majority of states. There's carriers here that service those plans with hundreds of thousands of members. And I can tell you, in the states where those plans are active, they have way more carriers participating on the exchange than we do, right? So, the idea of those models destroying the fully insured market, the evidence suggests otherwise. Their markets are actually more competitive than our markets here. So I think the answer here is, for those employers that are very small, providing some type of tax credit or monetary relief if they choose to buy fully insured products, looking at a reinsurance program. If we can afford it, maybe we can target it towards certain cases that blow up the pool, providing some parity between small employers and large employers. I would argue through AHPs or MEWAs. Some would argue through public option, but both have the same goal in mind. And then also, making sure that we, as I said at the outset, really gain an understanding of the laws that we pass and the impact those costs have on the market. Because I'll say it again, when the legislature saw the impact of a mandate on the state employee plan, the bill died instantly. But when we have bills that impose costs on small groups, we don't know the costs, we pass them. And then at the rate review, when the carriers are getting hammered by OHA and the AG and the DOI, that's when we find out what the cost is, right? It shouldn't be like that. That's not the smart way to legislate. The smart way to legislate would be to understand the cost of things before we pass them and fine tune them to make sure we get the most benefit out of them. So I think these conversations, we need to keep doing this. I don't think public hearings and raise bills every year necessarily foster conversations like this, but I think, from CBIA's perspective, we're willing to participate and collaborate with anybody on any side of the aisle to try and come up with a solution to this mess. Thanks.
Thank you, Wyatt. We're going to end there. We're 22 minutes past when we said we're going to wrap up, and I know it's rainy and people have other places to go to. Thank you so much for your participation, and I hope we can continue to have this dialogue in the future.